Hey everyone, and welcome back to the channel. In today's video, we're going to be looking at Google or Alphabet's first quarter 2019 earnings. We'll talk about some of the major numbers, and towards the end of the video, I'll give you my thoughts on the updated valuation of Google. How much is it worth based on their latest cash flow numbers? So let's just get straight into the numbers. So from their earnings release, we can see that they actually received a fine from the European Commission, which was $1.7 billion. And this is really no surprise to me. It's become a very regular thing that the European Union just decides or the European Commission in this case, decides they just fine Google because it breaches their policies. I mean, that's fine. That's something Google has to deal with, the regulations of different countries, but it is getting pretty ridiculous at this point. I think the EU has fined Google almost $10 billion in total. So it's an unusual item because it is a fine, but it is becoming a usual part of Google's business, which is something to worry about. But all the numbers that I'm going to talk about right now exclude that number. So we're assuming that that's kind of a bit of an anomaly, something that's not going to happen every year, even though it kind of has been. And let's just look at the core performance of their operations, of their actual business. So revenue came in at $36.3 billion, which was up 17% year over year. Net income was $8.3 billion, down 11% year over year. And earnings per share was $11.90, again down 11% year over year. Now, having net income and EPS down 11% year over year looks horrifying. Especially when we're excluding the EU fine from that. If you include the EU fine, it's much worse. But if you have a bit of a dig deeper, then you can realize that it's not a concern at all. A much better figure for Google's operations, for looking at how their earnings have grown from quarter to quarter or from year to year, is to look at their income from operations. And their income from operations was $8.3 billion, which was up 9% year over year. And the reason why this is a better representation is because of some of the new accounting rules that companies have to abide by when they're reporting their numbers. And essentially what it comes down to is if a company holds a lot of stock, so they hold stock in other companies, they have marketable securities, then the change in those unrealized gains will appear now on the income statement as something called other income. So because Google has a lot of marketable securities, I think they have 90 billion of marketable securities or something like that, 94 billion in stock. When that stock changes, depending on the market movements, that change will either be an income for the company or a loss for the company. And that will be called other income. So it's going to impact their net income. And that is the reason why their net income is down year over year, even though their income from their actual operations as a business is up significantly year over year. But an even better metric than income from operations for looking at the performance or the profitability or how much cash we're going to get back from Google is, of course, free cash flow. So free cash flow was $7.4 billion, which was up 72% year over year. And the major reason why it was such a massive increase was because they used half as much money in capital expenditures as they did last year. So their income from operations or their cash flow from operations was relatively the same as it was last year, year over year. But their capital expenditures were almost half, which means that their free cash flow, being cash from operations minus capital expenditure, ended up being 72% larger than it was a year ago. And you can see that they used some of that cash to repurchase $3 billion of their own stock. They used about $1 billion in stock compensation for staff. They bought a small amount of marketable securities in other companies, and the remaining $2.5 billion remained as cash on their balance sheet. And this essentially resulted in Google finishing the quarter with $19 billion in cash, $94 billion in marketable securities, and $391 million in long-term debt. This is genuinely the best balance sheet of any company, maybe even ever. This is the best balance sheet I've ever seen. There's no company that comes close to having this much cash and marketable securities relative to such a low amount of debt. And their ability, well, the reason that they've been able to do this is because their business needs a very small amount of capital to generate a huge return. The advertising business doesn't require many additional investments once there's more advertisers coming on. Once the infrastructure is in place for them to run their ad system so that businesses and marketers can come on and run their ads on Google products such as YouTube or through Google search, there's very, very little additional cost, incremental cost to Google, and this has allowed them to produce so much free cash. This is one of the best cash machine businesses that there is in the market, and they've done it with very, very low debt. Equity came in at 183.5 billion, which is up 34% in the past 3 months. So again, that's very impressive. They're growing the core value of their business, that being the cash and their assets minus their debt and other obligations. That core value has grown by 34% in just 3 months, which is pretty incredible. And during those 3 months, Google's stock was up only 15%, which means that based on equity, the company became significantly cheaper. And they also became significantly cheaper in terms of free cash flow. Again, we saw that free cash flow has grown by 72% year over year, yet their stock price has only grown about 15% year over year. So the price that you're paying grew by 15% during the past 12 months, but the amount of cash you got in the first quarter almost doubled. So you can tell that it's definitely relatively cheaper as long as they can continue that trend into the future. So talking about valuation, let's now talk about my thoughts on valuation and how much cash I think you can get out of Google over the next 10 years. Now, all of the opinions that I share in this video are just my personal opinion and for example purposes only, so that I can demonstrate the approach that I use and so that you can use this approach in your own research. None of this should be taken as recommendations or financial advice. And if you do need financial advice, taxation advice, or any other kind of advice, then I suggest you go see a professional who can deal with your personal circumstances. Now, over the past 12 months, including the latest cash flow numbers, Google has produced about $26 billion of free cash flow. So if we're going to do a valuation, we're going to start with that free cash flow number and grow it into the future to calculate how much cash we can expect to get back over the next 10 years. So if we project from now into the future over the next 10 years at a growth rate of 15% per year and using a 3% discount rate, so assuming that if we didn't invest in Google, we could invest our money elsewhere risk-free for about 3%, which you generally can with US or Australian bonds at the current time. So putting those numbers into an intrinsic value calculator, we would see that the intrinsic value of the future cash flows is about $435 billion, plus the terminal value at the end, which I've worked out to be approximately $80 billion, which brings the total intrinsic value to approximately, doing a very rough valuation, of about $510 billion. So that would mean that the stock is currently overvalued. It means that you're paying more than what you should expect to get back over the next 10 years out of this business. And we can look at this another way if we want to confirm whether or not this is a good time to buy or not. And another way we can do this is we can simply grow the free cash flow into the future and then apply a multiple so that we're working out what price we think the stock will be at in 10 years time. And if we do that, we can expect that the free cash flow for Google will be around $104 billion in 10 years time. So if we assume that they're trading at a 15 times multiple to their free cash flow in 10 years time, then the stock market, or the market cap I should say, of Google in 10 years time will be about $1.6 trillion. So if that was to play out, if they were to grow at 15% per year for the next 10 years and then they had a multiple of 15 on their free cash flow, so like a PE ratio, but we're comparing price to free cash flow instead, then you would make a little over double your money if you bought it right now. And essentially what that means is that you will make somewhere between 8 and 9% per year for the next 10 years if they grow at 15% per year. Now that's with no margin of safety. It has to grow at 15% per year just for you to make 8 or 9%. if they don't grow as quickly as that, you could end up making something more like 4 or 5% per year. So that's something to think about, that they are very well priced to grow massively. And of course, they do have the potential to grow massively, but it is very reliant on some of the smaller speculative investments that they're making at the current time, such as Waymo, their car, or their autonomous car fleet that they're working on. Some of these smaller businesses that they're building out have to become massively successful, like YouTube did and like their other core business pieces did. So I think they're definitely, in my opinion, they're definitely priced for premium at the moment. They're priced to grow very quickly. However, it is possible that they will grow at that pace. For me personally, it's not a business I would go near right now, at least because of the way that it's priced. I want to be able to assume that they can grow at maybe 10%, plus I want to get a margin of safety to ensure that if they don't meet my estimation, that I'm still going to make a good return. And Google just isn't one of the stocks that is offering that kind of return at the current time. So I hope you guys enjoyed this one, and if you did, please leave a like and let me know your thoughts on Google and their earnings down in the comment section below. But for now, guys, I'll see you in the next video.